Right, it's 1:03, so I think we will now get started. So welcome everyone, and thank you for joining this Transition Zero webinar. We're thrilled to have you here for the launch of our Coal to Clean Carbon Price Index. My name's Matthew Gray. I'm the co-founder and co-CEO of Transition Zero. And for this webinar today, we will be breaking it up into 3 parts. Firstly, I'll be joined by my colleagues Alex Truby and Jacqueline Tau, who will talk about the details and the findings of our index. Then we'll move on to a panel discussion. We're really fortunate to be joined by colleagues from the World Bank, Mercuria, and Mainstream Power. And then last but not least, we'll have a Q&A session. To answer a question, or sorry, to ask a question, just please click on the icon at the bottom of your screen and then post your question, and we'll note it and address that question to the appropriate person at the end. So before we get into it, for those of you who don't know Transition Zero is a climate analytics not-for-profit. We're really new. We were started in April last year, and our mandate is to develop open data projects to support economic and financial decision-making in electricity and heavy industry sectors. We are really grateful for the funding that we receive. Our main funders are the Quadrature Foundation, ECF, Generation Investment Management, Google.org, and Bloomberg Philanthropies. So just a quick point on social media. Please follow us on our social media accounts, Twitter and LinkedIn. If you are an avid tweeter, please use the relevant hashtag, which we've come up with is Coal to Clean. And also to get the webinar started, we have a poll, which is: what is cheaper, coal to clean or coal to gas in 2022? 2 options there, which is quite self-explanatory, either coal to clean or coal to gas, and then we'll reveal the answers at the end of this webinar. So the genesis behind our index, and this is something that is central to what Transition Zero does, is we believe that tracking the energy transition is never been more important, but we believe that existing metrics ignore the energy crisis, which started in 2021 and has been exacerbated this year, and the transformation required for a Paris-aligned world. So fuel costs have historically been analysed through coal to gas prices. Gas, of course, has a lower carbon intensity than coal. Therefore, the carbon price, if the carbon price increases to a certain level, it will become more economically viable to dispatch gas than to dispatch coal. And that level is termed the fuel switch price. There's an obvious problem with using this metric, and that is it ignores the transformation that is required over the next decade to align the electricity system with a net zero outcome. So, for example, the IEA's net zero emissions scenario foresees no unabated fossil fuel generation by 2035 in advanced economies and globally by 2040. Secondly, the energy crisis that started to emerge from a supply and demand imbalance last year and has been exacerbated by Russia's invasion of Ukraine has created extreme volatility in coal and gas prices, and this just isn't captured in long-term energy system models. So what we hope to do with our index is to price the cost of leapfrogging gas and transparently showcase the incentive for doing so. And that incentive has been, of course, exacerbated by the volatility in coal and gas, but has been in the same regard as inevitable due to the deflationary trends in renewable energy. So without stealing the thunder of my colleagues, this is the results of our index based on a global average of all the markets that we cover. And the index is an open data project which looks at the cost to switch from existing coal generation to either new onshore wind or solar PV, depending on what is cheaper, coupled with 4 hours of battery storage. And obviously the two trends are deflationary trend in renewable energy, starting ever since wind and solar were deployed at scale, and also volatility in coal and gas prices, which started in 2021 and has only become more extreme this year. And what we did with this chart, just to give perspective on what has been happening and to showcase how the recent events in energy markets have really brought forward the future of the energy transition. And that is just a transformation in the cost of moving from coal to clean technologies and the economic incentive to do so. And just to provide context to the energy volatility that we're seeing in coal and gas markets at the moment, it is unprecedented. And while we see a reversion to the mean, we think that fossil fuel volatility will be a feature of the energy transition for a number of reasons. I would now like to call on my colleagues, Alex Truby and Jacqueline Tao. The background to this index is I developed what I would call quite a buggy and clunky Excel model. And then I sent that model to Alex, who wrote production grade code. And then Alex and myself and Jacqueline worked together to make sure that the assumptions in the model reflected what was happening in Asia, which is a big focus of ours. And Jacqueline is based in Singapore and has significant experience of what is happening in gas and coal markets in the region. So Alex, can I call on you to talk through the mechanics of the index?
Yeah, thanks, Matt. So I'm just going to give a quick, pretty high-level overview of how we're gathering the data, and then how we're utilizing it in the index. So if you want to just quickly go to the next slide. So really, I think one of the biggest benefits of this index is the wide variety of data sources that we're pulling in. I'm going to focus here primarily on the commodity prices, because that is really the most, or at least one of the most influential factors in our calculations for the coal to clean and coal to gas prices here. So really what we're trying to balance is trying to find resources that are really time granular, but also really space granular. So if we can find an index that is up to date and near real time and also has country specific metrics, that's kind of our ideal and what we shoot for. And if we can find regional distributions within that country, that's even better. So that's kind of like our gold standard, and then we kind of work our way down from there. So we're pulling from real-time databases that may have a month or two lag, UN Contrade, ICE, EIA, days and weekly data points available for some of those. And then some of the areas where we really felt that the regional focus was more important, we're looking to annual PDFs that are published by institutions within the country. If we can find, again, regional prices that may be annual instead of weekly, we'll kind of use that and then lean on Jacqueline's expertise as well to help guide our forecasts and any other assumptions that we have to make based on those price assumptions. So I think, yeah, just the amount of coverage that we have in terms of data sources that we're pulling in is definitely one of the strengths of this index. And then again, for the VRE and storage, we're pulling from a few different resources there as well. And those don't fluctuate as much. Those tend to be a little bit more constant. If you want to go to the next slide. So we're using all of that input data, and all of these calculations are actually being performed at the asset level before we aggregate up to the country level metric. This metric specifically is supposed to kind of give a high high level viewpoint of what's happening at the country level, which is why we're aggregating it that way. And we're aggregating it kind of based on the weighted capacity of all the plants within a country. But at the asset level, before we roll it up, we're looking at plant efficiencies, emissions intensities, again, the fuel costs and carbon costs. Those are really the key inputs into our modeling. And from that, we're using those to calculate the short range marginal cost, as well as the levelized cost of electricity for both gas and the VR and battery storage. And then those really are the two main inputs to the coal to clean and coal to gas price. And then, so all of that's done at the asset level, just to give that regionality of variance within a country, which we do want to capture in order to get the average within that area, kind of the most representative that we are able. So we roll it up to country level, and then we present those findings. We have a dashboard on our website, which I'll give a quick overview of on the next slide, but feel free to go and play around with it yourself. There's a lot of information there, as well as we have a monthly data download in Excel format, which has all of these variables that I've just spoke to in that data download as well. So just a quick overview. Apologies, this is a video, couldn't do it in real time, but so this will always default to the global weighted average first. But in the dropdown, it's got all of the countries that we're modeling, which covers about 85% global coal capacity. You can look at switch to existing gas plants as well as switch to new build gas plants. And this will default to historical pricing, but we also have included a forecast out to the next 24 months. So just looking at Japan as an example for this, going to stick with existing gas, but maybe I want to look at the forecast. So you can see now we've included our forecast out to April of 2024. One nice thing with this dashboard is if you are really only interested in a certain time period, you can highlight that area of the graph. There's a little export button in the upper right-hand corner. And it will export only that time frame to a CSV or Excel download, which you can play around with yourself. Downside of the dashboard is that it's really only going to export the two main metrics, coal to clean and coal to gas, based on the filters in the dashboard. However, the monthly data download, again, has emissions intensities, coal and gas efficiencies, the short range marginal cost and LCOEs that are being utilized as inputs into the calculation. And one thing that we felt is most valuable is the coal and gas prices that we're using as inputs into this metric. You saw there's a wide variety of sources that we're pulling from to put these numbers together. A lot of them are pretty hard to find. Some of it, came from an attachment in, an article that we had to go and dig around on the website to find. And some of it is just really hard to scrape or gather yourselves, even if it is publicly available. So I think we're really leaning on this, or we're hoping this data download will provide ease of access to the data that we've done the work of going to gather, so that it can be used for similar purposes, or if you want to utilize that information for a variety of uses. I hope it's widely available to you all now. And additionally, we're working to get this metric on a variety of financial terminals. So hopefully we'll see that in the near future. And with that, I will hand it over to Jacqueline, who can talk more about the policy and finance implications of the index.
Yeah, all right, thanks, Alex. Hi, everyone. So for my time, I'll just like to spend a few minutes quickly going through what's happening in some of the key markets globally. So first, let us turn our attention to the EU. So essentially, the European narrative on fuel switching, in particular, pivot back to coal amid really sky-high gas prices, has really largely shaped the discussions that we're having now on leapfrogging gas straight to renewables and the energy transition. Now, it is now beyond a doubt that, a shift away from coal to renewables plus storage is now financially more attractive. And with no sign of the underlying factors driving the gas price rally easing up in the near future, forward-looking prices remain elevated, as you can see from the left-hand chart we have. So the cost advantage of coal to clean is expected to extend out to the next 24 months. Now, this gas to coal switch will inevitably push up demand for carbon permits, and this has translated to an almost parallel increase in EUA prices that we're currently seeing. Now, overall, in the near term, the EU is expected to see an increase in absolute emissions in the bloc, as demand reduction and energy efficiency are unlikely to offset the spike in coal-related emissions. Now, in the immediate term, there are actually more worrying trends, particularly in terms of looking at the future of coal in the region. So a direct impact of what's happening now in terms of the ongoing energy crisis is the retreat of Russian gas supply to the EU. Now, the knee-jerk reaction for a lot of the countries as well as gas buyers is actually to diversify gas supply. A prime example of this would be, Germany announcing a revival of previously stalled LNG import terminals, and a lot of the EU gas buyers looking to secure more long-term LNG contracts in the market right now. However, what this actually does is that it will continue to leave the EU at the mercy of volatile LNG prices in the future while locking in gas generation for some time to come. So with renewables complemented with battery storage looking increasingly cost competitive, we believe that it's an opportune time to divest investments into this zero carbon alternatives instead. So we're expecting this energy crisis to help accelerate the push towards energy transition in the EU. Now, if we move a little bit eastward to China, similar to the EU story, we are seeing that replacing cogeneration with renewable energy paired with battery storage is looking consistently cheaper than replacing cogeneration with gas plants. Now, this crossover starts happening from February 2022 for operating gas plants, and if we start looking at new built gas plants, we see that crossover happening much earlier in November 2020. Now, what this means is essentially it's putting at risk 77 gigawatts of gas plants at various stages of planning in China right now. In fact, investments all along the gas or LNG value chain in China are at the risk of stranding. So China actually signed a record high volumes of LNG term contracts last year, which stands at around 22.7 million tons. So some of these LNG contracts might actually last decades into the future. And if you're looking at the exposure of China to its LNG or potential for LNG stranding, if you're looking at really conservative gas prices of around $7 per MMBTU, all the deals that were only signed in 2020 amounts to $7 to $8 billion a year. So this, alongside all the investments that China has poured into in terms of gas pipelines and gas plants, might all come under risk of stranding. Now, in terms of market structure, the presence of regulated city gate prices may shield some of the Chinese gas plants from the fuel price volatility from international fuel price fluctuations. Now, what this does is that it suppresses fuel oil prices artificially in China, which means that it might mute or distort price signals to investors and place renewable energy at a false disadvantage. However, for China, the silver lining is that renewable energy investments are still maintaining momentum in China, and this is backed by not only the financial viability of renewable energy plus storage itself, but also by policy pushes best exemplified by China's peak carbon as well as carbon neutrality pledges, which has really facilitated capital flows into China's renewable energy sector. Now, if we turn our attention to Japan, which is actually a very interesting story as well, Japan's reliance on fossil fuel imports has really been exposed and seen its pitfalls. As you can see, Japan's energy sector being hit very badly by the price turmoil in the past few months. So the Japan case study really showcases that even in markets where renewable energy has traditionally been perceived as really high cost, the cost scale is actually tipping in favor of renewables plus storage. Now, if you look beyond costs, renewables has the added bonus of enhancing energy security. So traditionally, LNG has been known to be kind of more volatile and energy insecure resource, prone to price swings. And what the ongoing energy crisis has also revealed is that there are significant risks associated with the traditionally stable commodity, which is coal. So if you see the chart on the left, you can see that in the past few months, price swings to double the magnitude of average historical prices are seen in Japan, along with similar underlying supply risk, as you can see from Indonesia, banning thermal coal exports in the start of this year, which has really added underlying supply risks that were not typically seen with coal. So I'll just like to end off quickly with some of the key takeaways that we have. So firstly, definitely we call on investors and financiers to act now and invest in cost-competitive renewables. It is now the opportune time to build new renewables plus storage projects in the face of really sky-high fossil fuel prices that we're seeing in the market right now. We also like to highlight that fossil fuel volatility is likely to be an enduring theme as we look into the future, and investing in renewable energy actually provides a hedge against future price volatility. And for policymakers, we also ensure that there's going to be energy security benefits associated with renewable energy. Now, we'd just like to end off quickly with another one for policymakers. For policymakers, we'd like to highlight that fossil fuel subsidies actually often do more harm than good. We typically see fossil fuel subsidies in emerging Asian economies. And what they do is they likely hinder price discovery and prevent least cost outcomes in the electricity markets. Moreover, it also undermines the effectiveness of the various carbon pricing instruments that are under consideration in this markets, and it prevents the carbon pricing instrument in doing what it's supposed to do in terms of aligning capital flows with climate goals and net zero pledges at the country level. So that's all I have, and I'll hand over back to Matt.
Thank you, Alex, and thank you, Jacqueline. Very thorough explanation of what's happening underneath the hood of the index and what the results show in the different parts of the world. Now we'll move on to the panel discussion, but before I do that, please do keep sending your questions. We are noting them, and we will deal with them towards the end of the session. So the first panelist is Marissa from the World Bank. For those of you who have been involved in carbon pricing policy, Marissa really needs no introduction. She's been involved in the State and Trends report for a number of years now, and more recently has been doing some excellent work on carbon pricing and how it can help with net zero alignment. So Marissa, over to you.
Thanks, Matt, for that introduction. And I have just prepared a couple of slides. And so I think based on the metrics and the presentation that you guys just gave, I'll probably be diving in more to the policy side. And I believe my screen is being shared. So just to give a brief backdrop to the work that we do at the Carbon Markets and Innovation Unit, we really have, let's say, 3 different types of work that we do, all with the overarching framework of figuring out what role can carbon pricing play in helping countries figure out their development strategies and also to achieve their national climate change targets. And so the first one is looking at really targeted and tailored support to specific developing countries. And this is largely through vehicles like the Partnership for Market Implementation, which is the successor program to the Partnership for Market Readiness. We're not very creative with our title names, but we try to be more creative in our policy design. The second part is really a lot more technical work. So this will be things like the state and trends of carbon pricing, where we don't zoom in on one particular country, but we try to track developments around the world and also, look at technical topics that are relevant to a lot of different countries. And so I think databases like the Coal to Clean Power Tracker is going to be really useful to the way in which we do our work, and also thinking about what kind of metrics the bank can offer to help support not just policymakers, but researchers, investors in the private sector. And then the last part is looking at innovation and advocacy. So what kind of technology and tools can help, for instance, make carbon pricing adoption easier, looking at international carbon markets, and also advocacy work through the Carbon Pricing Leadership Coalition on carbon pricing. And so unfortunately, we are a couple of days before the launch of the new state and trends of carbon pricing, and I will probably be murdered by my colleagues if I give away the big headline numbers. But just to give a bit of a teaser, so this is last year's report figures, but as you can really see, carbon pricing is an instrument that's really been adopted in a lot of different combinations and shapes and forms around the world. I think, maybe if you were working on it 10 or 15 years ago, it's probably something where you would look in jurisdictions in the North Americas and also in Europe. But now, with coverage past 20% of global greenhouse gas emissions, we're seeing major developing economies like China experimenting with carbon pricing. We've also seen jurisdictions like South Africa and Indonesia also exploring the role of carbon pricing there as well. And there's almost, I think, 70 different types of carbon pricing instruments around the world today. In terms of carbon pricing, though, and I think this is where it's also useful to have a metric like C3PI, we can really see that there is a really significant gap between the take-up of carbon pricing around the world, but the kind of prices that we're really going to need to see if we're going to keep 1.5 alive. While you can see there are a lot of high prices towards one end, if you're looking at the bigger picture, carbon prices that are actually within the kind of range we need to see to really have that transformative effect is maybe less than 5%. That being said, the amount of revenues that carbon pricing produces has been really huge and significant, but that's largely driven by price increases in major ETSs, particularly the prices we've been seeing in the European Union. I think even despite the situation in Ukraine, you're still seeing pretty significant prices there. And so what are some of the drivers and trends of carbon pricing? I think there's sort of two key ones that we're seeing this year. The first one is this continued proliferation of net zero commitments, driving an interest in carbon pricing, and really looking not just as carbon pricing as an end of itself, but part of a broader energy risk management strategy. And on the other side, this is also being pushed by an increasing interest in cross-border approaches to carbon pricing. I'm sure most people on this call are sick of the CBAM acronym, but conversations on Europe's carbon border adjustment mechanism and the impacts that it'll have in sort of encouraging those countries with trading relations with the EU to really think about carbon pricing as a way to help them start to transition industries, to start to increase resilience, is something that where we're really seeing an interest in carbon pricing suddenly increasing. And, an interest that's broader than just environmental ministries. It's bringing in trade and finance ministries as well. And for more, I would just encourage people to tune in during Innovate for Climate on the 24th of May. But yes, there's still overall, I think, significant untapped potential. Short and medium-term ambition of carbon pricing, and also I think energy and climate policies more broadly do need to be strengthened in order to be aligned with actually achieving those net zero targets. And so I think starting to think about, not just what prices we need to see for fuel switching, but also what prices do we really need to see to start to drive that energy transition, like this index, is super useful. And finally, I just wanted to conclude with a couple of points about carbon pricing in the power sector, where we're really starting to do a lot more work through the Partnership for Market Implementation, and really looking at the fact that you're most likely going to have carbon pricing instruments cover the power sector. But the way in which we've seen carbon pricing work in generally developed economies that have fully liberalized power markets is really not the model that can be transposed one-to-one in jurisdictions like Indonesia, like Chile. I know Jacqueline talked about energy subsidies. I mean, almost all countries are going to have some kind of fossil fuel subsidy. And so thinking about ways in which you can design a carbon price to work where you have state-owned enterprises, where you have fossil fuel subsidies across the whole supply chain. What does that mean for carbon pricing design? Is it perhaps not appropriate in all situations? Should we be thinking about it more as, say, a revenue generation role? Should it have a mitigation role? These are basically some of the kinds of questions that we're starting to try and answer through an upcoming report at the bank, where I think, you know, some of the work that's being done in terms of the methodology that you guys have developed in coming up with this common metric, and also looking at how carbon prices can vary across regions and jurisdictions is really informative. And so I'm just going to stop here so that other panelists, hopefully I didn't eat into your 10 minutes. Thanks.
Thank you very much, Marissa, and looking forward to the release of your report on the 24th. I'm now going to move over to ask James Cooper to speak. James is the head of environmental products at Mercuria. Mercuria is a large commodity trading house. I was joking about this before the webinar started. James has been active in the carbon market since 2012, I believe. Started his career at Bloomberg, then moved to BP, and now, of course, is at Mercuria, and is quickly becoming what I would describe as a carbon market dinosaur. So on that note, James, over to you.
Cheers, Matt. And sorry, and Marissa, don't worry about eating to my time, because when people ask me, where can I learn more about carbon markets, I always say that the World Bank report is the equivalent of the Bible. And I think, Matt, you may have just created the Bible for fuel switching and coal and gas economics. So it's been great to see. And when I read the report, I had loads of ideas and thoughts and that I wanted to try and articulate, and I realized I probably need to try and structure them. And so I've tried to do so along the lines of some of the applications of the C3PI that you mentioned in your report. And the first of those was around aiding investors in decision making. And I think the way that you use it, and Marissa touched on this point, is it sort of depends on whether there's a carbon price existing in the country that you're working in or that you're looking at already. So if you look at countries where there is one that exists, Matt, when we were looking 10 years ago at fuel switch pricing in Europe and producing forecasts to what then seemed a long time away in 2030, but now to 2040, 50, people often wanted to use the fuel switch price for an understanding of operational abatement. The idea that you turn off coal, you turn on gas, and you reduce emissions in the process, and that was seen as the price signal for the carbon market at the point where it came short or scarcity pricing ensued, and that never really materialized to a large extent, although it probably did in 2-3 years ago. But obviously, what's been happening in Ukraine and certain supply side constraints within Europe have meant that fuel switch pricing isn't what's necessarily leading the carbon price in the short term. But if you look at the way that this C3PI can be used in markets that do have a carbon price outside of Europe, it's about being able to feel the carbon price and the power price, because that's how, as a renewable generator, you get an incentive, right? Just because the coal generator is having an increase in cost, you still need that to flow through to the power price, which is what you're seeing as a forward curve or something that you include in your discount cash flow models in your final investment decision when you're trying to make an investment. So the ability to see that into the future, to understand the dynamics and use that in your modeling, particularly if there isn't a liquid forward curve for the power price, it is really important, actually, and that's something where I see it potentially being used quite a lot. It's interesting. I'm going to get the name wrong here, but I think the Association of it's ACER, the Association of Energy Regulators, or something to that effect in Europe, They were talking recently about the need for more liquid price instruments for forward hedging for small power producers, particularly in the renewable sector. Although that doesn't exist yet, maybe this is a step in the right direction for sure. So that's been great to see. If you start to look at the markets where there isn't a liquid carbon price that that people could point towards, or one that exists, what you're really using the C3PI for is the direction of travel. It's about understanding when you're a company looking at capital allocation in the midterm, or these vast strategy teams that many large energy companies have. They're looking at how they allocate capital. I've worked for one, and the idea of internal carbon pricing exists and it is used, and it is a nightmare being in the room when they're discussing what price to use. And actually, a lot of the time, understanding the fuel switch and the power market dynamics is key, and this can really play into that and help. So there's going to be a real utilization of this, I would hope, on that front. The second set of comments I wanted to make were all around policy effectiveness and carbon pricing, and building on some of the things Marissa said. But one thing that the C3PI isn't able to capture inherently is, even if the signal is there that you should start to use renewables and shut off coal, it doesn't happen until the renewables are built, and you will still run the coal. Just because the short-run marginal cost of coal is increasing doesn't mean it won't be used. And actually, if you've got a need for additional capacity to be built within a market, this is ignoring great flexibility requirements, but if you need that, then both are going to be there and both are going to run. And it sort of speaks to the requirement for policy overlap. And I say requirement for policy overlap. Normally policy overlap is seen as a dirty word or a dirty phrase, but it doesn't need to be. Obviously in Europe it was probably done wrong historically, but there's lessons to be learned. You can need policy overlap. You need different types of incentives, particularly when different countries are at different stages of renewables penetration. And you look at Europe, you had the EU ETS, you had the price signal that wasn't high enough, coal plants were still running, and then the large combustion plant directive and the industrial efficiency directive aided in the reduction of coal plant run hours in the shorter term, and did so, some say to the detriment of the EU ETS price, but different measures that different carbon markets are looking at across the world, whether it's the market stability reserve or other types of measures in the US, in California, and in RGGI. You're seeing carbon markets understand how to account for policy overlap. One thing I would say is that it's interesting to see the nuance once you move away from the global weighted number into what happens in individual countries and site-specific the site-specific nature of what we're seeing and policies. But one thing that sort of spans all of them for me is that a carbon tax, or what the C3PI shows, is that the carbon tax isn't necessarily the best approach to trying to incentivize the changes that are needed. You see the volatility in the C3PI, which sort of speaks to the fact that a carbon tax with a preordained level trying to engender change maybe isn't the optimal solution. An economically optimal solution is a market-based incentive that is able to follow the way that the market moves, but also allows a hedgeable price instrument, which is key to the investment community. And so the ability to have something that allows a forward curve to be created is key. A carbon tax just does not allow it. People don't necessarily believe in the levels, and it's only the government that can reliably tell you what the future price level will be in 10 years' time. The last set of comments that I wanted to make were around one of the applications that you mentioned, which was how do you shape and inform civil society and the debate. And one of the conclusions that I think it's easy to come to with this is that cost reductions, learning curve, moving down the learning curve in renewables has led us to a point where renewables are competitive. And clearly they are, but I think we have to be careful and not to criticize, but it worries me looking at the global weighted number, because the global weighted sort of, you miss some of the nuance. And the problem is that in a number of countries, looking at India, for example, you show that I think it's a $50 C3PI for India around 2021, 2022. We've managed to access a lot of the low-hanging fruit, I would call it, but there's still a lot that needs to be done in order to support these technologies to compete with coal and to make their way into the energy mix. And I'd sort of say that what my take is that what this shows is that we're now at a level where carbon pricing, more so than direct energy subsidies, is able to really help bridge that make the last mile, bridge the over the last hurdle, and start to get us towards the point where we have more cost competitive renewables. And the area that I point to where this has been seen is in the carbon offset space. In the carbon offset space, there has been a lot of criticism and sort of people moving away from supporting renewables with offsets. Some of the main carbon offset registries are no longer allowing new projects or outside of LDCs. And to me, what the C3PI shows is that the blanket approach is silly. Right, you need to have a more nuanced approach. You need to support renewables where you can. And actually, in many of the countries we're talking about that lack liberalized power sectors, a carbon price is perfect. An offset price is perfect, because what you enable is an internationally set with forward curves. ICE launched one yesterday. The CME has them. Curves that allow people to factor that into the power price they're going to receive in the future, because they're getting those they can fix carbon prices into the future. To me, that is really important, and you're seeing certain carbon registries trying to capture that. So I think the Global Carbon Council is one that's taking a much more sensible and nuanced approach to supporting renewables with carbon markets. And with that, I will I think round up. Thank you.
Thank you, James. Really, really insightful comments there. I'll now move on to Adam. Please do keep your questions coming in. I think what we'll do, given we're a little behind on schedule, is that we'll run over by 5 minutes. I hope that's okay with everyone. I will have a firm stop at 1:15, because my 3-year-old is coming back into my house, and my chances of continuing to talk and continuing the webinar is limited. Adam, so over to you for your comments.
Thank you. I'll just wait for the screen to change, because I can still see you, whether you can see me or not. That's fine. I'm happy to start talking if you can't see me.
So I think it does default to you. So
that's
so
right.
Feel free to,
okay. Well, let's crack on. Although I am tempted just to stall this so we see your 3-year-old. I think that'll be much more entertaining than listening to me. Anyway, thank you very much indeed, Matt, and particularly to James and Marissa, as well as your colleagues, for a really interesting discussion so far today. And congratulations to Transition Zero on the launch of the index, which I think will be a really, really useful tool to underscore the economic no regrets benefits that will accrue to countries which accelerate their transition from coal to clean, let alone the climate and social welfare benefits. And I agree with James's point about the index being used to help us as developers develop our financial models, particularly as renewable energy producers are exposed to more market risks in more markets. I'll come back to the policy point as it is core, I think, to the efficacy of the index. But before I do, you asked me to say a word or two about Mainstream. We are 14 years old, founded in Dublin as a global pure play renewable energy developer with a focus on emerging markets, founded into the teeth of the last Great Recession in 2008. Last year, we were majority acquired by the Norwegian investor, Aker Horizons, and last month, they sold down part of their holding to Mitsui of Japan. So we are a truly global entity. We've also morphed from being a developer to being a long-term owner and operator of wind and solar power plant, storage, and potentially hydrogen production. We're now the largest renewable energy player in Chile and in South Africa. We're developing Vietnam's largest, I think Southeast Asia's largest offshore wind farm. We're active across the Americas, Asia and Africa, and our offshore wind business, which is based here in Edinburgh, where I am today, is active across all of those jurisdictions and here in Europe as well. But that's more than enough about us. Let me turn, if I may, today to the importance of the new index. In 2008, our industry globally was subsidized, regulated, and relatively small. That autumn, liquidity dried up almost overnight, and the renewable energy markets in the US, Canada, and Europe essentially froze. Many countries curtailed support, and in some, like Spain, they removed them retroactively. In those relatively early days, and for some years after, we hadn't really featured on the speed dial list of many, if any, finance ministries. Our networks were really with the energy and environment departments. And in the aftermath of the financial crash, we were told by government, we can't afford you. Reduce your costs and build local supply chains, then come back and talk to us. So we did. And over that period, as you know, because you've indicated it in the material you shared today, the costs of wind and solar generation have fallen off a cliff. And we've delivered low cost, high value electricity in markets around the world. We employ hundreds of thousands across a value chain that stretches from innovation around such interesting products as low carbon concrete foundations for turbines to high-end AI powering the operation of massive offshore wind farms. And Matt, as you and your team and your analysis show, wind and solar energy are clearly cheaper than any plausible alternative. And even more importantly, they can be developed and built faster, enabling the injection of new capacity into overstretched grids to meet the unserved demand of customers. And the speed of delivery matters. You can bring on now very large amounts of wind and solar and storage in half the time it takes to build an LNG terminal, or even to plug a power ship into your grid. And finance ministers now know us. And those of you who are at COP or witness some of the announcements from countries determined to move past coal will know that prime ministers and presidents know us now as well. And also companies know that long-term offtake agreements for wind and solar power now offer far more value than exposure to gas markets or continued exposure to coal, which is why we are seeing so much growth in the corporate offtake sector as well. Just one example over the last quarter was Anglo American's announcement to source 100% of all of their electricity needs in South Africa from renewables by 2030, which could amount to some 5 gigawatts of additional wind, solar, and storage capacity in the market. But that isn't enough. Our focus now has to be on the remaining non-price barriers, which has been raised by James and others in the conversation already. And perhaps the biggest in most markets is simply that electricity systems were designed with coal and hydro as the backbone. Grids were built to link mine mouth generation to centers of demand, and wind and solar generation tend to be in different areas. And the issue is recognized, and we can see the start of an accelerated program to address it. The Just Energy Transition Projects, or JETP, to give them the acronym which they've adopted, launched at COP for South Africa and now for APAC, are both about funding the just part of the transition and the transition itself. So in South Africa, comparatively small amounts of capital in grid reinforcement can unlock large amounts of new capacity, and Eskom is already looking at the potential for large-scale solar generation plugging into the grid built for legacy coal plant. Grid is critical. Developers like Mainstream do find the best site for generation and grid. 2 years ago, we built the first ever private high voltage transmission line in South Africa and delivered it to Eskom to enable the connection of our wind farms and others. But that's, at the moment at least, an unusual occurrence. Grid remains either government or government agency owned and operated, and even in Europe and the US takes a very long time to plan and build. Offtake is another issue which is improving, but is still shaped by the generation profile of coal. State-owned utilities are not designed to be entrepreneurial. Here again, JETP or something like it can work with them to help shape a new regulatory framework for variable renewables. And it should be noted, unlike a decade ago, we don't need particularly special treatment in the market either. In Chile, for example, we compete and win as wind and solar against old coal and new gas in technology neutral auctions for new electricity capacity and we have to provide firm power. And we can from building a portfolio of projects and having access to a relatively liquid spot market. So if you want to see what success for renewables looks like and just how quickly we can replace old coal, have a look at Chile's experience over the last 5 years. It is very instructive. Technology neutral auctions, regular procurement, carbon price, and the construction of new grid have combined to enable the country to advance their timetable to come off coal completely. But cost should not be the only determinant, and I sort of want to finish on this point. We're cheaper than coal and gas, yes, but to be even cheaper means destroying value in our supply chains and confining our OEMs to negative growth. We need now to procure renewable generation on a mix of criteria, including cost, but taking a broader look at our system value and our wider economic impact, which is again why the launch today of the index is so important. I do want to be optimistic today. COP in Glasgow increased the momentum for change. Decision by China, Japan, and Korea to stop the export finance for coal has really driven change in APAC particularly. We expect Vietnam to publish its 8th power development plan in a matter of weeks, which will show how that country is transitioning very, very decisively from very large amounts of coal, moving probably swiftly past gas, straight to wind and solar generation. The Philippines has just launched, along with the World Bank, its first roadmap for offshore wind. Indonesia is taking baby steps, but they're baby steps in the right direction. The barriers to the energy transition are no longer ones of technology or cost. They're about policy and market reform. And that's where this index will be critical in prompting governments, regulators, and other state actors to go further, faster. Matt, I hope I've stuck to time. We've got some time left for discussion. Thank you very much.
Thank you, Adam. Very, very insightful. So we're now going to move over to the Q&A session. I'll be chairing that. We have received a lot of questions, which is amazing, but we do have time constraints, so we'll do our best to address them all. If not, we'll follow up via email. So first question, this is going to be directed at you, Adam. I remember 5 years ago, we were in Singapore talking to policymakers and investors, telling them how cheap renewable energy was going to get, and that they should act accordingly. And, you know, fast forward to 2022, it feels like our dreams have come true. But as you noted, economics isn't everything. Our index does paint quite a rosy picture about how quickly the transition could occur. So I was just wondering, do you want to go into a bit more detail on what some of the non-price barriers are for Southeast Asia? Because obviously Southeast Asia, I feel like, is the last battleground for fossil fuel development.
Yeah, absolutely. Gosh, was it 5 years ago in Singapore? That was the same year that at the Singapore Energy Conference, Big Singapore Energy Conference, a very senior representative of the IEA was the headline speaker, and it was all about gas and carbon capture and storage. I don't think they would make the same speech to the same audience today. Matt, the barriers in Southeast Asia are in some sense no different from the barriers in any other market that is transitioning from predominantly from coal. And if you imagine in most of those markets, even in the Philippines, which is a deregulated market, we're still talking about large coal-fired incumbents, and they're not going to step back from their incumbency overnight. And the markets that have grown up around their incumbency, all the regulatory structures to underpin that are not going to be replaced overnight. But I think there are two drivers, two or possibly three drivers. One is obviously cost, price, and you can see in the dramatic transformation of Vietnam. And I sort of see Vietnam as I'm trying to think of the opposite analogy from a canary in the coal mine, but you follow my drift, I hope. From a power development plan 7, which was still about building more coal, perhaps building more gas and a little bit of renewables, to power development plan 8, which is really maxing on the transition to renewables. There's still coal and gas in it, but it's a very, very different profile. And now we need to see the regulatory and legislative transition that will get us there. It's the same for the Philippines, same for Indonesia, same for other markets. And the other driver, which I touched on, is I think corporate offtake, and don't undersell the success of organisations like the RE100, which have really driven a corporate appetite for renewables, and in APAC, in Asia Pacific, which, if it remains, which I hope it does, the engine room of global economic growth, it's those very large global brands that are going to be going to the government of the Philippines, the government of Vietnam, the government of Indonesia, and saying we've made a public commitment to only have renewable electricity. What are you going to do about it? Because we don't have to come and invest in your country. We can invest next door or one over there. And I think it's a combination of factors, and the winners will be those that can manage the regulatory restructuring policy that underpins it, that opens markets to increased renewables penetration.
Excellent. So I'd like to move to James now. James, my question is around price formation in the EU ETS. What our index shows is that you don't really need a high carbon price to transition from coal to dispatchable renewables. So I'd just like to get your opinion on whether and to what extent price formation in the EU ETS will change. Obviously, the big price driver at the moment is coal to gas fuel switching, but obviously, we've exhausted much of the gas spare capacity. So obviously a decision has to be made to build new gas or to transition to renewables. Do you want to give us some of your thoughts on that based on your experience?
No, absolutely. So yeah, I mean, you hit the nail on the head. So we are now at a stage where price formation is not centering and long-term forecasts where people are modeling the expected carbon price do not center on coal to gas fuel switching, right? It's a lot of it is in the money for reasons other than the carbon price, and the carbon price isn't going to engender additional switching. So when you look at what is the determinant of a long-term EUA price forecast, or even the price in the market, if we take today first, a lot of it is about expectations of the future, right? So we're trading, I think, 90 euros a ton today. We're up quite a lot this week. We had a slip earlier in the year when the geopolitical tensions rose, but the EU ETS's prices proved pretty or remarkably resilient afterwards, moving back up. And people are looking to the future, and there's a certain amount of sort of financial and sort of hot money, so to speak, inflow that is supporting the price upwards. But it's always with a view to, well, what should the price be? And we move to a situation where people look at industrial abatement costs. And what that means is, what price does one of the large European refiners change something within their refinery during a turnaround? What price do people use bio-based feedstocks rather than relying on fossil? What's interesting there is those tend to come in at quite a bit higher prices than the historical price levels that we've seen around the renewable sector, and clearly come in higher than the coal to clean numbers that you've come up with, independent of the carbon price, right? They clearly come lower down on the abatement cost curve that we will look at. But what's interesting is that as we look to the future, those types of abatement are capex based and capital allocation based. They take longer to do. They need a long-term price incentive that people can capitalize on, and I think we're slowly starting to see people leverage those. But what I'd say, the work of Transition Zero, I hope, going forward in some areas, is that you start to analyze and produce equivalent C3PI type indices for those other sectors. You guys look at the heavy industrial sector, which would benefit from it, because they do not exist in reams and reams haven't been written about those in the same way as the power sector, and it's clearly the next frontier. And maybe one last point on that is, it also points to the reasons why we can't have a global carbon price. or it's a bit of a myth, right? You need sectoral based, you need nuanced carbon pricing, and Marissa's chart of the different prices historically showed and attest to that. But one thing that wasn't on there, that was you have these implicit, non-explicit carbon prices based on things like the transportation sector. So the cost to change, the cost of a ton of emission reduction in Germany today to replace diesel with a biodiesel is around €400 a ton, and that's a traded environmental market. So those are the sorts of numbers that people will look at in the future. I accept that at the moment EU ETS doesn't have transport in, but hope it explains the direction of travel.
Excellent, thanks, James. So lastly, I'd like to move to you, Marissa. You mentioned that the World Bank is going to look closely at carbon pricing in regulated power markets. That is something that I've been concerned about for a number of years now. So taking Korea, for example, they have a reasonably high carbon price. But once you factor in free allocations, subsidies, that price that regulated entities pay is actually pretty low. So there's this delta between the market price and the material price. And I'm just wondering, how should policymakers think about that as they transition to fully expose, regulated entities to the explicit price, like what has happened in the EU ETS for a number of years now?
Yeah, thanks, Matt. And I would just also caveat that obviously the World Bank more broadly has been working on this issue for a long time. It's rather a new collaboration between the Carbon Markets Unit and our energy global practice. But I fully agree. It's part of this broader puzzle that we're trying to figure out of seeing carbon pricing as a useful tool, but the ways in which it's been applied are not really one-to-one transfer cases from largely developed country scenarios to developing countries. I mean, even then, the way the EU uses its ETS is radically different from how California or RGGI designed their programs. And so I think part of the work that we're doing is really looking at it from the broader context of, okay, what are your goals for the power sector? Do you want to increase renewables? Is your goal to reduce emissions by this much by 2030? Are you going for net zero? And then with that backdrop in mind, let's see, what are all the other policy tools you already have going on? And I think this brings in James's point about looking at indirect prices. I mean, a lot of those policies are already sending some kind of signal, whether they are positive or negative. And so part of it is also factoring in how basically you can have a carbon price work in what is essentially a very crowded space. And unfortunately, I don't have all the answers. I guess otherwise we wouldn't be writing this report. But it's a really big issue because economies like China and India are those with very large regulated power sectors. And so if they are going to use carbon pricing in some kind of format, it's important to understand what impact that signal will actually have and how we can actually start to experiment and design it in a way that makes sense for them. Whether it's using shadow prices, whether it's thinking about designing it in the ways in which, Tokyo and the Republic of Korea have used it. So happy to also continue this conversation, also with James and Adam, as well as we progress this work.
Excellent, thank you for that answer, Marissa. Very, very thorough. I think I'll do one more question before closing the webinar, and I'd like to call on you now, Jacqueline. So one question we got was, the future's pretty uncertain, particularly if you look at the macro environment. We have inflation rampant at the moment, which means that the cost of capital is likely to increase, and renewables being a capital intensive industry could result in big implications. So can you talk us through some of the assumptions for the forward-looking renewable energy costs, and in particular the cost of capital?
Yeah, sure. You're definitely right in saying that, right now there are potentially risk of renewables coming in a little bit higher than what we expected due to supply chain issues as well as capital, cost of capital issues. So the way that we've managed it is we have taken, at least in this iteration of our C3PI, we've taken existing cost of borrowing rates and aligned it with our calculations for LCOE. But going forward, the way that we intend to treat this is to take on potential interest rate changes going forward and incorporate it into our analysis so that we have that we take into account the inflation the inflation impacts of changes in weighted average cost of capital WACC costs in our future ongoing renewable energy plus storage costs. In terms of the potential supply chain issues which might lead to elevated renewable energy costs, I think this is something that we are tracking actively. I think there are a lot of numbers floating around on potential, supply chain risks flowing on to renewable energy costs in terms of wind as well as solar. Right now, I think there's two different views that we can take. So efficiency upgrades and technology advancements might offset some of that cost increase, but that's definitely something that we'll continue to track in terms of supply chain risk for renewable energy. I hope that helps to answer the question a little bit.
No, it does. Thank you very much, Jacqueline. So on that note, I think I'll close the webinar. I'd just like to thank the panelists for doing such a good job of explaining the financial and policy implications of our index, and for everyone who dialed in. I think it's one of the first webinars I've been on where the attendees or participants has remained consistent throughout the hour and 10. So thank you so much for dialing in. And if there are any questions that are unanswered, we will endeavour to reply to those separately. And if you have any other questions, then feel free to get in touch. We are very easy to get in touch with. So thank you very much, everyone. And thank you again to the panelists.